Let me paint you a picture. You have AED 2000 this month to invest. You could put it all into one company, one stock, and hope that company does well. Or with that same AED 2000, you could own a tiny slice of 50, 80, even 200 different companies at once. Banks, technology, consumer goods, healthcare, all at once. That second option, that is mutual fund. And in this video, I am going to take you through everything you need to know about Indian mutual funds, what they are, how they work, the different types available, what kind of returns each type has delivered, backed by real data, and how to start thinking about which one is right for you. Whether you are investing for the first time or you have already started and want to understand what you own, this video is for you. Remember, a mutual fund is not one investment, it is a basket and you own a piece of every fruit in it. Welcome to Investing with Siddick. I am Siddick and this channel is for NRIs in the UAE and across the Gulf who want to build long-term wealth in India and globally. This video is part of the Investing 101 playlist, our foundation series. If you watched the asset allocation video, you know we talked about splitting your money across different types of assets. Mutual funds are one of the main tools for doing exactly that, especially for investing in Indian stocks and bonds. So let's build that understanding properly. What is a mutual fund? At its core, a mutual fund is a pool. Thousands of investors, you, me, someone in Sharjah, someone in Bengaluru, all put money in. That pooled money is then managed by a professional fund manager who invested based on the fund's goal. The company that set up and runs mutual fund is called an AMC, an asset management company. HDFC Mutual Fund, Mirai Asset, Parag Parekh, Axis, SBI, these are all AMCs. They hire the fund managers, they manage the money. All of this is kept in check by SEBI, the Securities and Exchange Board of India. SEBI sets the rule for what each fund can hold, how it must show its portfolio to investors, and how your money is protected. Indian mutual funds are tightly regulated, and that's a big reason why they are a trustworthy starting point for NRI investors. What is NAV? When you invest in a mutual fund, you don't buy stocks directly. You buy units of the fund. Each unit has a price called the NAV or net asset value. NAV is the total value of the fund's portfolio divided by the number of units calculated at the end of each market day. Here is a very common mistake I want to clear up right now. A lower NAV does not mean the fund is cheaper or better. NAV is not like a stock price. A fund with a NAV of rupees 15 is not better value than one with NAV of rupees 800. What matters is how much the NAV has grown over time, not the number itself. Never pick a fund because its NAV looks low. Remember, NAV is just price per unit. A lower NAV doesn't make it cheaper. Don't fall for that trap. Before we go into the different type of funds, let me quickly cover why mutual funds are a particularly good fit for NRI investors like us. First, diversification with small amounts. Buying 50 Indian stocks directly from UAE would take a lot of money, a lot of research, and constant monitoring. Mutual funds give you that spread from just AED 500 or 500 rupees through a SIP. Second, professional management. The fund manager and their team watch the market full time. You don't need to follow quarterly results of 50 companies. You invest in the fund's goal and let the manager handle the work. Third, liquidity. Most open ended equal funds can be sold on any business day. Your money is not locked up the way real estate or fixed deposits can be. Fourth, you can invest directly from your NRE or NRO account. No complicated setup. If you already have an NRE or NRO account with an Indian bank, which most UAE NRIs do, You can start investing in mutual funds from the same account. The process is now much simpler, especially through direct platforms, which I will cover in an upcoming review video. And fifth, SEBI regulations. Every AMC, every fund, every holding is shown to investors every month. You always know what you own. Remember, you don't need to track 50 stocks. A mutual fund does that for you, and SEBI makes sure it does it honestly. One thing NRIs must know before investing in Indian mutual funds: when you sell your units, the AMC deducts TDS before paying you. The rates depend on the type of fund and how long you held it. For equity funds, if you sell within 12 months, the gain is short term and TDS is 20%. Hold beyond 12 months, the gain is long term, taxed at 12.5% on gains above 1.25 lakh per year. Debt funds and hybrid funds with less than 65% equity are taxed at the investor's applicable income tax slab rate, regardless of holding period. TDS is deducted at the maximum rate up to 30% or applicable rate by the mutual fund at the time of redemption. NRIs can file an income tax return in India to claim a refund. Now, here is the important part of UAE NRIs specifically. India and the UAE have a double taxation avoidance agreement, a DTAA. This means you are not supposed to be taxed twice on the same money. And since the UAE has no income tax on your end, this DTAA can significantly reduce or in many cases eliminate your Indian tax burden on these gains. To use the DTAA benefit, you need two things. First, a tax residency certificate called a TRC from UAE authorities, which prove you are a UAE tax resident. Second, Form 10F. You can use this to claim back your TDS while filing income tax returns. I will cover the full DTAA process, the TRC, and how to file an ITR as an NRI in a dedicated video because it deserves proper detail. For now, the key takeaway is this: TDS at source is not the end of the story. For UAE NRIs using the DTAA correctly, the net tax on your Indian mutual fund gains can be significantly lower than what is deducted upfront. Before I cover fund types, there is one decision every mutual fund investor must make, and most people get it wrong simply because nobody told them the difference. Every Indian mutual fund exists in two versions: a regular plan and a direct plan. Both plans invest in the exact same portfolio, same fund manager, same stocks, same bonds, same AMC. The underlying investment is completely the same. The only difference is the cost sitting on top. In a regular plan, a distributor, which can be a broker or an app or a bank, has sold you the fund. They earn a commission from the AMC for bringing you in. That commission sits inside the expense ratio of the regular plan, making it higher than the direct plan. In a direct plan, there is no distributor. You go straight to the AMC or a direct only platform. No commission, lower cost. And since the portfolio underneath is the same, that lower cost goes directly into higher returns for you. Over 20 years, the difference for the exact same fund can add up to over 50 lakh rupees going to a distributor instead of staying in your account. This is where the expense ratio really matters, not when you are comparing two completely different funds, but when you are comparing two versions of the same fund. It's the same product at two different prices. Always choose the direct plan. Remember, direct or regular, same fund, same manager, same stocks. One keeps your money, the other shares it. The choice is obvious. Now let's map out the mutual fund world. SEBI has defined clear categories, and every Indian mutual fund must fit into one of them. This is actually a strength of the Indian system. You always know what kind of funds you are getting. Equity funds invest in stocks. They carry the highest risk. Your investment can fall 30 to 40% in a bad year, but over 10 to 15 years, equity funds have been the highest returning asset class in Indian consistently. Within equity, the subcategories define the size of companies the fund invests in. Large cap funds invest in the top 100 companies by size. They are more stable but a little lower on the upside. Mid cap and small cap invest in smaller companies. They provide higher growth but also higher swings. Flexi cap can give the fund manager freedom to go wherever they see the best opportunity. ELSS funds are equity funds with a 3-year lock in. They offer a tax deduction under Section 80C for people with Indian taxable income. For most UAE based NRIs who don't file Indian income tax returns, this benefit may not apply. So check your own situation before going this route. Remember, equity funds can fall hard in the short term, but over 15 years in India, they have always come back and grown. Time is the only thing they ask of you. Next is index fund. They are simple, low cost and passive. Index funds are a type of equity funds that simply track a market index like the Nifty 50 or the Sensex. There is no fund manager picking stocks. The fund just holds whatever is in the index in the same proportion. Because of this, the cost is much lower, often under 0.2% per year. Now, here is something worth knowing, especially if you have heard that index funds are always the better choice. That is largely true in markets like the US and UK, where most active fund managers fail to beat the index over time. But in India, it's a different story. Many actively managed Indian funds have over long periods beaten the index. The market is less covered by research. There are far more pricing gaps, and a skilled fund manager can find real opportunities that an index simply won't capture. So, for Indian investing, the answer is not always index or always active. Both have a place. Index funds for a low cost core, actively managed funds for the potential to do better if you choose carefully. I will go deeper on this in a separate video. Remember, in the UX, index funds beat most active managers. In India, active funds have often returned the favor. Know your market before you pick your approach. Debt funds invest in bonds such as government bonds, company bonds, and short term money market instruments. They don't give you equity level returns, but they are far more steady. The return range is roughly 6 to 9% depending on the type and where interest rates are. For NRIs, debt funds play an important role in your overall plan. They are the steady part of your money when equity markets are having a rough year. Liquid funds and short term funds are best for money you might need within 1 to 3 years. For longer periods, corporate bond and government funds offer a bit more returns with some interest rate risk. Remember, debt funds won't make you rich, but they'll make sure the wealth you have built doesn't disappear when market gets rough. Hybrid funds are the middle ground. Hybrid funds invest in both stocks and bonds in a single fund. They give you growth with less up and down movement than a pure equity fund. Aggressive hybrid funds typically hold 65 to 80% in stocks and the rest in bonds. Conservative hybrid funds hold more bonds than stocks. One type worth knowing about is the Balanced Advantage Fund, also called a Dynamic Asset Allocation Fund. This automatically adjusts how much goes into stocks versus bonds based on how the market is priced. When markets are expensive, it reduces stock exposure. When markets are cheap, it increases it. If you don't want to actively rebalance your own portfolio, this does a lot of that work for you. Gold ETFs and gold funds give you exposure to gold prices without physically holding gold. For NRI investors who want gold as a buffer in their portfolio, which we covered in the asset allocation video, gold ETFs are the most practical and cost effective way to do it. Remember, there is a fund for every goal and every risk level. Your job is not to find the best performing fund from last year. Your job is to match the right fund to your own life. Let me bring this together. A mutual fund pools money from many investors and put it to work based on a clear goal: stocks, bonds, hybrid, or other assets. Your investment grows as the NAV of your unit goes up. You can start small, invest regularly through a SIP, and get professional fund management without having to pick individual stocks yourself. Always invest through direct plans. Same portfolio, same fund, lower cost. Over the years, that saving compounds in your favor rather than going to a distributor. Choose your category based on how long you are investing for and how much movement you can handle. Equity for long term wealth, at least 7 years. Debt for stability and shorter needs. Hybrid for a blend. And remember, in India, actively managed funds have a strong track record of beating the index. So don't dismiss them too quickly. Now I need your help with something. In the upcoming Indian mutual funds review playlist, I will be doing deep dives on individual funds, not just the category, but the actual fund, the manager's track record, how it held up in the tough markets, what's inside, and whether it belongs to the NRI portfolio. Tell me in the comments which fund do you want me to look at first? A fund you already hold, one you have heard about, or one you are thinking of starting. I will read every comment, and that's how I will build the review list. Remember, knowing which category to invest in is the map, knowing which fund to choose is the compass. I will help you build both. If this was useful, please like and subscribe. It helps this channel reach more NRIs who could use this kind of content. In the next video, I am covering ETFs and specifically why there is only one type of ETF that makes sense for NRI investors in UAE. It is to do with where the fund is based and the difference it makes to how much of your money stays with you versus goes to tax. I will explain exactly what to look for and what to avoid. As always, everything in this video is for learning only. Nothing here is personal financial advice. For decisions specific to your own money and your own situation, please speak to a qualified financial planner. See you in the next one.